Philip Morris International Inc., stock ticker PM, is the world's largest publicly traded tobacco company engaged in the manufacture and marketing of tobacco and related products. Originally founded in 1847, Philip Morris International is now a $145 billion market cap global tobacco monster that employs nearly 80,000 people. Fiscal year 2022 revenue can be broken down geographically as follows: European Union 38%, East Asia and Australia 16%, South and Southeast Asia 14%, Eastern Europe 12%, Middle East and Africa 12%, the Americas 6%, and other 2%. Philip Morris sold approximately 622 billion cigarettes in 2022, down slightly from approximately 625 billion in 2021. The company's global market share of cigarettes is an estimated 28%, excluding China and the US. This incredible market share is due largely to the strength and ubiquity of Philip Morris's Marlboro brand, the #1 cigarette brand in the world. This one brand alone comprised more than 39% of the company's total cigarette sales volume for last year. It is one of the most dominant consumer brands in the world, and dominant brands tend to stay dominant as long as the brand is taken care of. That puts companies with dominant brands in a powerful spot. What makes Philip Morris especially powerful in this respect is the fact that the company combines a dominant brand with the addictive nature of the product. A company can go far with brand loyalty alone, but Philip Morris takes that idea to the next level by adding addictive properties to the equation. That equation spits out an end product that is highly price inelastic. That is, an increase in price doesn't significantly reduce demand. This kind of pricing power is very uncommon, and it's a potent antidote to counteract the unfavorable industry dynamics, which is decreasing volumes. But wait, there's more. Management figured out a while ago that the traditional cigarette industry is a melting ice cube. In response, Philip Morris started a number of years ago to transform the entire business model by investing in cigarette alternatives, most notably its IQOS HTUs, or heated tobacco units. IQOS uses heat not burn technology that is designed to produce a similar but less harmful experience for its traditional cigarette customers. In addition, Philip Morris recently, in late 2022, acquired Swedish Match, the Stockholm-based maker of Zyn nicotine pouches, boosting Philip Morris's exposure to non-cigarette products. The strategy appears to be working. Whereas cigarette volume is down 1.3% year over year for the first 9 months of 2023, HTU volume is up 18.3% year over year, and oral nicotine volume is up 14.4% year over year. Moreover, smoke-free products are now comprising 35.4% of the company's total net revenues as of the first 9 months of 2023. That number was less than 1% as recently as 2015, and Philip Morris is aiming to get more than 2/3 of its total revenue from smoke-free products by 2030. Put simply, Philip Morris is positioned extremely well for continued revenue, profit, and dividend growth for years to come, despite industry dynamics and a changing environment for nicotine products. To date, the company has increased its dividend for 16 consecutive years. That track record is as long as it could possibly be, dating back to the company's initial spinoff from former parent company Altria Group Inc., stock ticker MO, in 2008. By the way, Altria Group retained exclusive ownership of the Marlboro brand for the US market. The 10-year dividend growth rate for Philip Morris is 4.7%, although more recent dividend raises have been closer to the 3% area. Far from amazing growth, no doubt about it. Two things to keep in mind though. First, that lack of growth is somewhat offset by the stock's market smashing 5.6% yield, a yield that is 10 basis points higher than its own 5-year average. When you're starting off with a near 6% yield, you don't need a whole lot of growth in order to make sense of an investment, especially from an income-oriented perspective. Indeed, many investors right now are chasing fixed income instruments that yield less than 6% and don't offer any income growth at all. The second thing is Philip Morris is priming itself for an acceleration in growth over the coming years thanks to its investments in smoke-free products. Whereas pretty much every other traditional cigarette company is slowly diminishing, Philip Morris's relatively modest annual volume declines in its core product is allowing time for the smoke-free products to grow and start to take over. It's the only setup like it in tobacco. I don't know of any other large company in the space that has so clearly articulated a realistic plan and then gone out and executed on it. The large dividend is protected by a payout ratio of 85.7% based on midpoint guidance for this year's adjusted earnings per share. Elevated, yes, but the company has been working with an elevated payout ratio for years. However, seeing as how it is so high, growth of the dividend will be limited to growth of the business. The payout ratio just cannot be expanded anymore. For income-oriented dividend growth investors, there's a lot to like here. Looking at business growth, Philip Morris increased its revenue from $31.2 billion in fiscal year 2013 to $31.8 billion in fiscal year 2022. It's a compound annual growth rate of 0.2%. Mixed picture here, flat revenue over a decade, not impressive. On the other hand, the fact that Philip Morris was able to keep the revenue base intact in the face of its core product experiencing secular decline says a lot about the firm's pricing power. Meanwhile, earnings per share grew from $5.26 to $5.81 over this period, which is a compound annual growth rate of 1.1%. Bottom line growth is nearly as uninspiring as top line growth. If this were all that's in store for shareholders over the next decade, there'd be little to be excited about here. However, again, anyone investing in Philip Morris today must have some enthusiasm and belief when it comes to the future viability of smoke-free products. Otherwise, Philip Morris is just another melting ice cube. In the end, we invest in where a business is going, not where it's been. Looking forward, CFRA is forecasting that Philip Morris will compound its earnings per share at an annual rate of 7% over the next 3 years. That's a bit more like it, right? Clearly, CFRA is seeing the promise of the new products and how those volumes should lift the fortunes of the overall business. The $16 billion acquisition of Swedish Match, combined with years of IQOS development, uniquely catalyzes a new growth process that is unique in the industry. I think this quote from Philip Morris's Q3 earnings release says a lot, and I quote, "ZYN nicotine pouch shipment volumes in the US of 89.9 million cans, representing growth of 53.1% versus second quarter 2022 Swedish Match shipments of 58.7 million cans," unquote. That is the kind of volume growth that can make a staid tobacco company exciting once again. It's estimated that ZYN's share of US nicotine pouch market is somewhere around 60%, so it's actually an even more dominant brand than Marlboro is. Quite incredible. Philip Morris's own guidance for this fiscal year 2023 is calling for 10% to 10.5% year-over-year adjusted EPS growth, so CFRA's 7% call doesn't sound unreasonable at all. Now, I wouldn't pull out the champagne bottles. Dividend growth will likely remain somewhat modest in the near term as the payout ratio is elevated and Philip Morris's debt load is high. After all, that Swedish Match growth was purchased with debt. Still, the pickup in growth does at least alleviate fears over what kind of long-term future the business may have. Furthermore, additional cash flow can be used to reduce the debt load while also steadily compressing the payout ratio in order to set shareholders up for larger dividend raises when looking out past the next couple of years. Patience is needed, but something better than a mid-single-digit dividend growth rate could be in the cards here. When starting off with the high yield, it's tough to complain about that. Moving over to the balance sheet, Philip Morris has a good financial position. Because of negative shareholders' equity, there's no debt-to-equity ratio. We can see that the balance sheet carries nearly $35 billion in long-term debt. Is this egregious for a company with a market cap of $145 billion? I don't think so. The interest coverage ratio is over 10, which indicates no issues with servicing the debt load. Prior to the Swedish Match acquisition last year, Philip Morris had been making good progress with paying down debt and deleveraging the balance sheet. Between fiscal year 2017 and fiscal year 2021, long-term debt had been reduced by 20%. The new growth and cash flow should help the company to get back on track with this debt reduction process. Profitability is outstanding. Net margin has averaged 26.9% over the last 5 years. ROE isn't applicable because of negative equity. However, return on invested capital has averaged 36.4% over the last 5 years. Philip Morris is adapting to changing industry dynamics, which is exactly what you want any business to do. It's transforming from a slow growth cash cow focused on a product in secular decline to a fast growth play on safer nicotine delivery. And with pricing power, brand loyalty, global economies of scale, and high barriers to entry, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. The very business model introduces above average regulation and litigation risks. Smoking bans, prohibition on flavored tobacco products, and crackdowns on e-cigarettes are all examples of rising regulatory pressure on the business model. On the other hand, competition is somewhat limited as the entrenched players, while competitive with one another, are unlikely to see any major new competition ever because of how impossibly difficult it would be to start a new tobacco company from scratch today. Being headquartered in the US and reporting results in USD, but deriving most of its sales from outside of the US exposes the company to currency exchange rates more than the average US-based business. Any slowing of the worldwide adoption of cigarette alternatives, primarily via ZYN and IQOS, would harm the company's ability to offset traditional cigarette volume declines with growth elsewhere. Lastly, Lastly, any speed up in the annual contraction of cigarette volumes would harm the company's ability to transform itself. While these risks are formidable, the business model is also formidable, and with the stock's price down 11% from its recent high, the valuation prices in a lot of issues. The price-earnings ratio is sitting at 18.2. That's using GAAP trailing 12 months earnings per share. Using the company's midpoint guidance for adjusted EPS for this year, the forward PE ratio drops to 15.5. Neither number is super demanding. The sales multiple of 4.3 is also not very high, and it's lower than its own 5-year average of 4.5. And the yield, as noted earlier, is slightly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 4.5%. The number I'm using is very close to the company's own demonstrated dividend growth rate over the last decade, which is 4.7%. Now, I am aware that recent dividend raises have been lower than this. However, on the other hand, the near-term forecast for EPS growth is quite a bit higher than my number. The payout ratio is elevated, and so management will have to be measured when it comes to the size of those dividend raises over the next couple of years. That's why I'm basically back to square one here and believe that Philip Morris will right the ship and get back to its own long-term average on dividend growth. The dividend discount model analysis gives me a fair value of $98.80. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates PM as a 4-star stock with a fair value estimate of $103. CFRA rates PM as a 4-star buy with a 12-month target price of $110. I came out on the low end, and perhaps I'm a tad bit too cautious. Averaging the three numbers out gives us a final valuation of $103.93, which would indicate the stock is possibly 10% undervalued. Here's the bottom line, guys. Philip Morris International Inc. is executing a massive transformation and showing rare growth in a field where most other businesses are struggling with volumes. It's a best-of-breed business positioned for better days ahead, with a market-smashing yield, a sound payout ratio, mid-single-digit dividend growth, more than 15 consecutive years of dividend raises, and the potential that shares are 10% undervalued. This cash cow with a unique growth catalyst could be perfect for income-oriented dividend growth investors. And now for a special news announcement. Fastenal Co., stock ticker FAST, just announced a special dividend of 38 cents per share to be paid to shareholders this December. Fastenal is one of the best performing dividend growth stocks of all time, up 101,000% since August 1987. Truly remarkable. The stock looks just a tad pricey here. Most of the multiples are just a little bit stretched. That includes the price-earnings ratio of 30.7, which is ahead of its own 5-year average of 29.4. But any slight pullback would be a good reason to take a close look at this special business. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.